Hello and welcome to lesson 6, and today we're going to discuss intra-week market reversals and overlapping model. And today we're going to talk about valuation by speculation, which is what you can see here, and we're going to define what valuation by speculation is, utilizing intra-week market reversals. Now, if you notice a lot of time, especially on Mondays, usually Mondays and sometimes early Tuesdays, you notice the market all of a sudden running aggressively, no economic release, no nothing. Right, the market just opens up and then starts running like 50 60 pips. Let's say you're bullish and you see the market just run right out the open, just runs lower like 50 60 pips in price. If you noticed that before, now what do you think that is? And usually this is usually a lot of time, 80% of the time it's a Monday, and oftentimes or sometimes it can actually happen on Tuesdays. Right, but during the first 2 days of the week or during the early portion of the week, you see the market make an aggressive run counter to your daily order flow. Now, what a lot of people tend to do is they tend to fall for this. Now, if I did this, let's just, so I'm going to use the most recent weekend price action to explain intra-week market reversals. But if we went back and you looked at each new week, you're going to see something similar. Not every time, but a lot of time you're going to see something similar. Now, it might not be in form of a lot of pips sometimes, but you see that usually during the first day, or even sometimes Tuesdays, you see the market make one move, sometimes very aggressively, counter to the weekly range expansion. So this is current week. You can see this aggressive run lower. You can see the previous week. You can see another run lower, not as aggressive as this one, but still a significant run lower. And this, the other week, just none of that. Okay, against intended weekly direction. And then on this one, you actually get that on a Wednesday. So this was a more consolidated market profile. Now once you get an aggressive run on a Wednesday, the market starts to see displacement. And then let's look at the 4 weeks back actually. Thursday, Wednesday, Tuesday, Friday, Thursday, Wednesday, Tuesday, Monday, and you can see what I'm talking about. On Monday you get that aggressive run higher. And if you think this is just a small amount of pips, this is actually 88 pips. Imagine you see the market run higher by 88 pips on Monday. That obviously sucks you into think you're bullish, because if you try to short any of this premium here, the market runs through all of that. So now you're confused about what the market is doing. So a lot of times at the open, or the first day of the week, usually that's a Monday, and oftentimes you can also get that on Tuesday. You see the market make one aggressive. Here it looks like Monday did nothing, but on Tuesday you actually see the move, even though it's a little bit not as pronounced as the other ones. But that move is what we call the jitters swing. It's not my term, but it's called the jitter swing because, again, obviously if you're into Christianity, Jesus betrayed Jesus, and it's the move that betrays traders. It sucks traders in one direction and then engineers liquidity in the opposing direction. That's why we call it the jitter swing. Now, this is the classic weekly manipulation template. So in the classic price action week, majority of the time you're going to see price delivery form like this, whereby the early portion of the week, the market will run a significant level of stop, a significant lower time frame level of stop. And what that does is that engineers liquidity against your intended daily order flow. And this is what we call valuation by speculation. All right, so now with this, when we see a fast market intra-week, we have to assume that price is reaching for a level of institutional order flow that is highly critical for efficiency at an interbank level. Okay, that level could be in form of a level where central banks are allowing commerce to facilitate globally, or a level where central banks are allowing interbank traders to participate in order flow or price action delivery. But whenever we see speed, especially early in the week, this is indicative of price reaching a valuation point on an interbank level. So, for example, the central banks will price aggressively during trade announcements, right? So whenever you get high impact economic release, especially like interest rates or FOMC, NFP, right? High impact releases like that, it's not because of the economic release the market is seeing that aggressive delivery. It's because there was manual intervention from the central bank where they're repricing the market to a very specific level to facilitate transactions. And if you go back and you actually do your research, you're gonna see a lot of times the price delivery does not actually match the actual delivery. The price delivery or the actual candles does not actually match the economic data that came out with the economic release, right? And this is why I don't actually look at the numbers for economic release to anticipate where price to deliver up or down into. I just see where price is trading relative to the range and relative to what the current open flow liquidity is. And then I can easily forecast or predict where the drawn liquidity should be, regardless of whatever the news is saying. I don't care what the news is saying. All I'm looking for is what the open flow liquidity is, and then I can use the news to aim for that. Okay, so again, central banks will oftentimes price aggressively during trades announcements, and these movements during news releases, they aren't attributed to buying or selling. It's not because there's buyers and sellers in the marketplace. It's causing the market to just aggressively run higher or lower. Okay, it is due to repricing by the central bank at the central bank level, which is why you see really aggressive movements in price action. Now, the key here is that the aggressive price delivery you see during high impact releases is a response to a central bank intervention. Alright? But during early periods of the week, Mondays especially, and then Tuesdays, when you see that same level of price delivery aggressively in one direction counter to your daily order flow, okay, that's not caused by news releases. Now, sometimes, again, not every time, a lot of times actually it's not caused by news releases. But, again, sometimes it might be caused by news releases early during the week. But when you identify price delivery like this is not caused by an economic impact that you can attribute to a central bank intervention, and prices moving aggressively, then that is based on the valuation through speculation by the central banks. Because price is being driven by IPDA from, in this example, since we're being bullish, from a premium to a discount. And a lot of times that will be down to an higher time frame level. So if you went back and you just doing the same thing I did, and you went out class all the manipulations, so you can see here, this is the jitter swing, and this is something I want you to do as an assignment or on homework. Alright, so go and identify the jitter swing during the week. Now, sometimes you can get jitter swing on Wednesday, and it all ties in with the weekly template, right? If you're anticipating, consolidation on Monday and Tuesday, then Wednesday is where you see the jitter swing, and that's usually based off of the economic calendar. But if you're not expecting, that meter consolidation to Wednesday, Thursday, rally or decline, then classically Mondays and Tuesdays you would see what we call the valuation by speculation, which is not as a result of economic releases. So what I want you to do is I want you to go and box each valuation by speculation and use that to build an understanding of price delivery. Alright, so this one is on Tuesday, this is on Monday, this is on Monday, and then if we went the week back, this is on Tuesday. There's a short little run higher. It's not a lot of pips, but that is around 59 pips. Right, imagine, right, just think about this. This is actually a Wednesday, not a Tuesday. Alright, I'm sorry. So, we have Monday consolidation, Tuesday rapid decline, and Wednesday that's where we see the actual displacement coming, and then the displacement starts. And then if you go back to this Monday, just imagine seeing 88 pips in one direction on a Monday. What does that do to you psychologically if you were actually bearish? Now you think your bearish sentiment was wrong because you've seen the market reprice against you by 88 pips. Same thing this week if you're actually bullish and you see the market just decline lower by 110 pips or 107 pips. What would that do to you if you're looking for bullishness? Obviously, that shakes you out of the bullishness because you've seen the market aggressively expand lower. And this is all a very sudden run. And this usually is what happens in price. Market just makes a very sudden run into a level. And it looks like it's just a random level. But actually, it's not a random level. Actually, it is a level which is a salient higher time from PD array. So like the one we had most recently, which is say it's Saturday, so that's this week. That was a run into this daily fair value gap. Now we've talked about fair value gaps, whereby fair value gaps are different from civils and bases because they can get completely filled and still be valid as long as we don't see the candlestick body or the market close through the fair value gap. Then it's still valid. So what we saw this week was we saw the market trade down into this fair value gap coupled with a bullish order block. Actually, it's not a bullish order block, it is a propulsion block because it forms inside a bullish order block, and that's why I see this much of a displacement higher versus this one here, right? So you can see this significant run here, which is a lot compared to this because this is a propulsion block. So now you see the market trades down into the propulsion block with a fair value gap, and on Monday it makes that sort of run lower. Now at this point, in hindsight, you can look back and say, oh yeah, that obviously looked like a very good buy there. But again, at the time all of this was forming, or you remember the analysis I said, don't go in looking for sells. Don't go in looking to short the breaker block because we're actually bullish. If you try and do so, you get burned by the marketplace because the order flow was bullish. And in bullish order flow, again, this is where it all stems from the daily time frame. Without an understanding of what the daily journal liquidity is, you would get so caught up in the lower time frame patterns, and that's the fastest way to lose a lot of money, especially trading with institutional. When you're just looking at the patterns, you're focused on the models, on lower time frame, without the context of the high time frame price delivery. Now price is being delivered in the context of high time frame delivery. You can get so caught up in looking at all these different little models and patterns and all these ideas you think you have in the lower time frame, and they would not work because you have no high time frame context. And this is what I was talking about intra-week, that your intra-week setups will form or originate from key high time frame levels. So if you're looking for bullishness, you're looking for key high time from discount raise. If you're looking for bearishness, you're looking for key high time from permanent raise. Now the main question here is, what do you do when you have no daily buys? Because if you go through the history of me doing the commentary, there's times where I don't have a bias. And what do I tell you I do? Step aside, do nothing. But that's the problem. You feel like you need to always have a bias every single day, and that's not how our time frame analysis works. Right? If you don't have a very clear understanding of where price is coming from and where price is going to, then navigating the lower time frame is going to be a lot of mess. Hella mess for you. Because you don't really have a full picture of what price is doing. Alright, you can go in and try to trade the lower time frame liquidity runs, but it's not gonna be as profitable. It's not gonna net you a lot of money because you have no idea of what price is actually doing. So you need the high time frame for context. It puts into perspective lower time frame price delivery. That's what the high time frame does. So during the early part of the week, we have a small little consolidation. Okay, small little consolidation. Now at this point here, everyone thinks the market is going higher, right? Because the market has been going higher. We have a resistance here, which has now become support, which the market has tested, seen higher prices. We have a new resistance here, which has now become support. The market has seen a bounce, so we're now all bullish. So what do? We jam our stops below the most recent low, which is here and here, because now we're expecting the market to just keep going higher and higher and make tons of money. And then the market does this. Oh wow, the market is falling about 100 pips. 100 pips decline. Now what's happening? Well, market is now bearish and we're looking for the market to run stops. So if we retest an old low, which is support, become resistance, that's a shorting opportunity. So this front lower was actually run to an high time frame discount to allow interbank traders to repopulate with new longs. But at the same time, it is engineering open flow liquidity intra-week. Where's engineering open flow liquidity at? Above the short-term high, and if you zoom out above this side here, because you're definitely individuals who are shorting this, protecting their orders up above here. Okay, and then what does the market do? Now, in between that daily candle, you can see this is Sunday's open price. We have that there. And what you can see here is price starts to displace higher. Right? Look at the opening price. Right at the discount low of that daily bullish fair value gap. Right there. As soon as we leave that daily fair value gap, look at the speed of delivery and the massive displacement. What if I tell you about that? Whenever you see this, you don't expect a return back down to fair value gap. Your range actually starts from, and this is a little bit of an advanced, not sure if I should go into advanced price action delivery. Because we have a change in style of delivery from bearishness to now bullishness, with the expansion out of that daily inefficiency, this becomes your new range. Alright? But we're not gonna go into this because that's a little bit advanced price action delivery. And you can see here the market expands, institutional offline drill. Where is it doing this at? Where is it reaccumulating orders at? Where's your opening price? Right? Closing price was here. Opening price was here. And if you divide the range in half, that's your mean threshold of the range. And you get that in price. Look at all the wicks. Where's the trend down into? The consequent correction of the Sunday's open price, and you see the displacement because we're in a anticipated stronger trend market condition, so we don't expect those series of longs like in consolidated market profiles. That I can still get series of longs in trend market conditions, but again, not on the leadership. Okay, you anticipate them on the sicker pair. Okay, the ones that's sicker. Because on the leadership, you're going to see a ton of expansion. Now, that does not mean you cannot get terrace of launch like this. You could say this was a terrace of buy. Okay, it is a specific time where you can anticipate the manipulation, but you're not going to get them as often as the weaker pair. So this is cable, which is the leadership, which I talked about. All right, I already told you before, and for those of you guys who are wondering what I'm saying, on the evening commentaries, we've talked about this pair being the leadership in terms of strength. If you compare this with Euro, which is correlated asset, and look at all the times where we're seeing higher prices in cable, and look how many times you saw runs and sell stops. All right, like here. All right, here we're seeing higher prices in cable, we're seeing high lows, Euro's running sell stops, we're seeing massive displacement to upside. Then we saw a retracement lower. Euro also ran sell stops internally inside the range. And then as soon as we saw a break higher, return back into discount of the range, higher low, lower low, higher low, also higher low. Here we see massive displacement, and then we'll see a return. But what I want you to notice, take note of, is how we're making IRRs on cable. So your cable is making IRRs here, and Euro is making lower lows here. And then on Monday, cable actually makes a run, that aggressive run lower on Monday. So that's where you see the disparity between Euro and cable. Now that does not mean Euro is now the leadership pair. Remember, our leadership premise originated from the daily time frame. Okay, so it does not just change day in, day out. Now watch the willingness I want to displace between Euro and cable. Alright, you can see here Euro is not cable. Sorry, this is cable. Cable is not making a lower low in price, but Euro is making a lower low in price because that's the sicker pair. All right, so let's keep watching and watching. And this is, I think this is Monday, Tuesday. This is Wednesday, right? And then this is a Thursday. And what I want you to watch is the willingness in price. I want to displace higher and make new highs. All right, see how much willing they are. Now this was the day where they both trended higher, all right? Because obviously we saw large ranges on dollar, and this is where they are currently. And you can still see that cable is making higher lows and euro is making lower lows. So remember how I taught you to navigate this. All right, if you're looking for counter trend trades, the better pair to trade would be the Sika pair. If you're looking for torus trades, now it can sometimes, not as much as the Sika pair, but it can sometimes occur on the leadership pair. But you need to understand the context of the manipulation. Now, if you look at the economic calendar for this week, right, which is the most recent week, the one we're talking about. So let's look at the economic calendar for this week. So this is Monday, 12th of June. I'm going to go into 12th of June and see what led to that decline on cable. And it was nothing. No economic release. That is classic hallmark valuation by speculation, because it's all a manipulation play, right? It's a manipulation play down to an higher time frame level, and in the process that induces liquidity or that engineers overflow liquidity against intended daily buys. So you don't fall for this because you have the context of the daily buys, right? But if you didn't have that context of daily buys, you're confused as to what price is actually doing. You're wondering to yourself, what is price doing from here? And this is what we're talking about. Okay, so this is understanding intra-week market reversals and overlapping models. Not a lot of things to go through except just discussing valuation by speculation. But on the next lesson or video, we're going to go through an actual model, which is a one-shot, one-kill trend model. And this is something I'm going to have to take time to prep for. So I will get that to you tomorrow. In the meantime, have an awesome weekend, and I will see you later on. Be safe.